Good afternoon, everybody. Thanks for tuning in to the Timeless Truths for Investing webinar. It's right at noon here, so we're going to give about a 2-minute buffer for those who are jumping on as we speak. So just hang tight and we'll be starting shortly. And just a reminder, we are live here. We're just going to give about another minute for a few more people to log on and join us. We'll get started shortly. Okay, well, we'll go ahead and get going formally here. Again, good afternoon. Thanks for taking the time to join us today. On behalf of Hummel Financial Advisors and Eventide Asset Management, just a warm welcome here this afternoon. In an effort to keep this concise over the lunch hour here, we're going to go ahead and get started pretty quickly. I did want to say there is a question and answer opportunity. There's a button at the bottom of your screen. If you have a question at any time, feel free to hit the button, type your question, and then we'll field all those before we wrap up at the end. So again, there's an opportunity for questions. We will be recording the presentation. So if you need to leave early or need to share or would like to share with a friend or just to view it later, that will be available as well. So we are fortunate to have with us Jason Myhre from Eventide to share today's conversation. And just so you know, this is not a product pitch conversation. This is intended to just share wisdom and really just for your benefit. So Jason is going to be sharing that wisdom with us here. So go ahead, Jason, take it away.
Well, thanks, Andy. And just want to say my own warm hello to everyone joining in for a topic that I hope will be very beneficial for you. The title is Timeless Truths for Investing. And we will be discussing those classic lessons in investing that have been gleaned throughout the history of investing. And if you can internalize these concepts, it will make you a successful investor for the long haul, I believe. And so before I jump into the content of the presentation, it's always good to know who you're listening to. So this is a little bit about me. I'm Jason. Good to meet you. I am a managing partner of a company called Eventide. We are an investment company that's based in Boston, and we provide mutual funds. And so advisors like Andy work with us in providing investment solutions to you, clients. My day-to-day work is spent in the area of advocacy, where I do a lot of public speaking and giving talks like these. And my primary focus is on helping people to remember to bring their values into their investing decisions. And you'll hear a little bit about that toward the close of this presentation. And with that, we will jump in. So what I wanted to do here at the beginning is to share with you some news headlines about investing. So these are all from last year. And we remember what a crazy year it was last year. So this was in January 2020. This is from Barron's, the most well-regarded investing publication. The method behind the melt up. So instead of a meltdown, a melt up. Why the Dow won't stop at 30,000. Next headline, same magazine. This is in March 23. what Washington needs to do right now to spare America a second Great Depression. So what happened? COVID hit, the market completely melted down instead of melting up. Then a month later, on my birthday, April 27, they said, in this stock market, anything could cause the next panic. So it looks pretty dire, right? Well, by the end of the year in December, the S&P could gain another 10% next year. Lo and behold, it ended up being a good year in the investing markets. Now, it was a very unusual year last year, to be sure, but I'm here to tell you that if you follow the investing world as I do, headlines that whipsaw like this are not altogether uncommon. In fact, I think this is really par for the course. And all of these kinds of emotion-inducing headlines can really lead us to think about our own investing program and say, like, man, do I need to do anything different here? What about my investing? How, in general, should I think about investing in the current market environment, which is always changing? Well, I'm not going to talk about current events. I'm going to talk about timeless truths. And this is the collected wisdom of 150 years of investing. In my opinion, the best ideas. I've got 5 points to share with you. I'll put them up on the screen. We'll walk through each one in turn. So number 1, keep your eye on the owner, not the dog. Number 2, restrain yourself. Number 3, employ a system that forces you to buy low. Number 4, remember the most powerful force in the universe. And number 5, invest in businesses, not markets. We will start with the first one here. Keep your eye on the owner, not the dog. What in the world, right? Well, it comes from one of my favorite quotes on investing, which was said by this man, Ralph Wenger, who is himself a very successful investor. And he has a very memorable illustration about how the investing market works. And I want to share it with you. He says this. He likens the market to an excitable dog on a very long leash in New York City, darting randomly in every direction. Can you picture it? The dog's owner, the person that's walking this dog, is walking from Columbus Circle through Central Park to the Metropolitan Museum. Now, at any one moment, there's no predicting which way this pooch is going to lurch. But in the long run, we know, don't we? He's heading northeast at an average speed of 3 miles per hour. But what's astonishing is that almost all the market players, big and small, seem to have their eye on the dog and not on the owner. Now, hopefully this metaphor makes a little bit of sense to you. I'm going to make it real plain on this chart here. What we're looking at is the entire history of investing in the US stock market, going all the way back to its very inception in 1871. Actually, a lot of work getting all this data together. The blue line here is the stock market performance with all of its ups and downs, twists and turns. In the metaphor, this was the excitable dog on the long leash in New York City, darting randomly in every direction. There's no predicting which way this dog is going to lurch. Similarly, there is no predicting which way the stock market is going to lurch. Okay? Now, what about that yellow line? What's that? Well, that is the best fit line for the data. It is simply to put a trend line on this history, and it's a straight line. There's no curvature to it whatsoever. Take a look at this chart, and what do you see? Investing, when viewed from a distant perspective, has been a straight line perspective, straight line experience up and to the right for 150 years. Now, in the metaphor, this was the owner who's walking the dog purposefully north and east, right? That is up and to the right at a steady rate. And in investing terms, that steady rate of growth has been 6.7% per year since 1871. So what is the lesson here for us? The lesson is that it is so tempting to watch those headlines like in Barron's, to watch the market and say like, oh no, the market had a big drop today, or wow, look at the market today. And we get distracted by the dog. And what we forget about is that long-term vision about why we're even investing in the first place, which is that businesses have been a great way to grow your money over long periods of time. So try to keep your perspective on the yellow line and not on the blue. All right, lesson number 2, restrain yourself. It sounds like I might get a little personal here. Well, indeed, I am going to get personal because there's an incredibly important personal dimension that all of us have to reckon with if we're going to be successful investors. We have to deal with the enemy within. So I want to talk about this with you. And to do that, I want to share with you here an article from the Wall Street Journal. You can see we're going back in history a little bit. This is December 31, 2009. So every decade, there is crowned some new king of mutual funds, depending on whichever mutual fund puts up the best track record for a given decade. You can see here, this is the very last day of the decade of the 2000s. And what this article is the coronation ceremony for the king of mutual funds in the 2000s, the best stock fund of the decade. And that fund was called the CGM Focus Fund. And I've circled in green here in the opening paragraph how that fund performed. They got an amazing 18% annual return. Now, if you're not real savvy on investing, what that means is that on average per year for those 10 years, this fund returned 18%. So just killed it. Now, I have a question for you, and I'm actually going to hit you with a poll, which is going to show up on your screen. And the question is this. Okay, so the king of mutual funds in the 2000s got an 18% per year return. How did the investors in that fund do? Did they get that full 18% return, or did they get something less? And I've given you a range of choices here for you to weigh in on. Awesome. You guys are taking to this. The best fund of the 2000s got 18% per year return. How did the investors in that fund do? Did they enjoy the full return, or did they get something less? Very good. All right, last call. Okay, I'm going to call it done here, and I'm going to share the results on the screen. So here's what this audience thought. So very interesting. No one said they got the full return. So you guys are onto something here. And then there, 17% of the audience said they got 12 per year. 75% of the audience thought they got 9% per year. 8% thought they got 2% per year. Well, let's look at the right answer. It is worse than you all think. Check this out. Next paragraph. Too bad investors weren't around to enjoy much of those gains. The typical CGM focused shareholder lost 11% annually, meaning they lost 11% per year for 10 years. Now, how is this even possible? This is the very best investment you could have chosen for the decade in mutual funds. It's getting 18% per year. The investors in that very fund are losing a pile of money every year. How is it possible? Well, they explain. These investor returns, also known as dollar-weighted returns, incorporate the effect of cash flowing in and out of the fund as shareholders buy and sell. Investor returns can be lower than mutual fund total returns because shareholders often buy a fund after it's had a strong run and sell as it hits the bottom. So here's what's happening. People want to invest, so they start shopping for a fund. They want one with a good track record, of course, and so they find this fund and they say, wow, look at the return on this thing. And so they buy it after it's had a strong run of performance. So they're buying it when it's expensive. The fund will experience a downturn. All funds have downturns, but they'll make a mistake. They'll ride it to the bottom and then they'll give up. They say, I bought a dog, get me out of here. So they cash out. So they bought high, sold low. Lo and behold, the fund will recover. It'll put on another impressive streak of performance, which will attract a new set of investors who will buy it at a high, who will give up at a low. This happens over and over and over again, such that the fund on average is doing very well, and the investors on average are doing very poorly. Hopefully you get the way in which that works. I want to share with you a quote here. This is from a book on psychology called Thinking Fast and Slow by Daniel Kahneman. You can see in the fine print here that he won the Nobel Prize in economics. Very influential book in my industry, and I'll save you the trouble of reading it if you can just get this quote. He says, the premise of this book is that it is easier to recognize other people's mistakes than your own. Isn't that a classic word of wisdom? Isn't it easy for us to look at that example of the CGM Focus Fund shareholders and say, oh, those fools, but not me, right? I wouldn't have made that mistake. Had I been investing in that fund, I would have stuck it out and enjoyed the full return. Well, would you have? So we looked at the investors in one fund. I want to show you the investors in all mutual funds. Okay. So this is generalizing this concept. What we're looking at here, this is the latest data on the returns of various investments over a 20-year time period. The latest data goes through the end of 2019. Very best investment over the last 20 years of this data was real estate investing that returned 11.6% per year. Next is a high yielding investment, small cap or small companies, emerging markets. Here's the S&P 500. This is a blend of stocks and bonds, a different mix of stocks and bonds, bonds themselves. You can see here, this is the sale of homes. Look at this, the average investor. The average investor barely beat out the rate of inflation. So their money is barely outpacing the inflation rate. Now, these are the investors across all mutual funds. And so the question is, now wait a minute, aren't these average investors investing in all of these kinds of things? Well, yes, they are. So why are they at the bottom of the list? It is for the exact same reason that I illustrated with the CGM Focus Fund shareholders. We love to chase a hot return, and we always give up in the hard times. This is just investor psychology 101. In fact, I love this quote from Morgan Housel, who says that finance would be better if it was taught by the psychology and history departments at universities rather than the finance department. And I actually agree with him as it relates to our average investor. Let me share one more quote on this point. This is from Charlie Munger, the partner of Warren Buffett, a very legendary duo, who says that the big money in investing is not in the buying or the selling, but in the waiting, in the sitting. So when you invest, if you're always thinking like, ooh, when's the right time to buy? Or when's the right time to sell? Like you are on a trajectory for failure, in my opinion. What you need to be doing is saying to yourself, how can I sit here and restrain myself? Because I am often my own worst enemy. So that's point number 2. Point number 3, employ a system that forces you to buy low. So we talked about controlling your emotions and trying to not buy things when they're expensive and sell when they're cheap. You want to buy things when they're at low prices and sell them at a higher price later. There's actually a systematic way that you can do this, and I want to share it with you. And I'm going to illustrate this using an experiment. And this is going to be another opportunity for a poll, so you'll have to pay attention here. I want you to imagine with me that we were dropped into history somewhere between the year 1920 and 1979. So we could land in 1920, we could land in 1935, we could land in 1947, etc. And our job, no matter where we parachute in, is that we have to invest in the US stock market for the next 40 years. Okay, this is your job. I'm going to give you a choice between 2 different investing strategies for that 40 years. So option 1 is that you can invest $100 a month. Very simple. Option 2, you can save up that $100 a month, keeping cash on the sidelines, and you can wait for the market to dip. So whenever the market pulls back, that's when you invest. You try to hit those market bottoms. But you're not going to have to guess. I'm going to really sweeten the deal here on this second option. I'm going to grant you perfect knowledge of the future so that you don't have to wonder when the market's going to crash. You would have seen the market bottom for the great financial crisis, for coronavirus, for example, and you will know the perfect days to buy. Question is, which of these 2 strategies would you choose? And I'm going to put this choice up on the screen. So one more time, option 1 is $100 a month. Option 2 is saving up $100 a month, keeping cash on the sidelines, buying the dips in the market, and you'll know when they occur. You have 40 years to invest, and your financial future hangs in the balance. Great. Excellent. Last call. All right, I'm going to call it done here. Share the results on the screen. So 58% of you said you'd take option one. That's $100 a month. 42% said they'd take buy the dips. That's option two. Okay, so let me make a comment here. Option two sure is enticing, isn't it? I mean, come on. You just save up all your money and then you just unload it on the perfect possible day. How could that not be a slam dunk? And option one sure seems unlikely, doesn't it? In fact, I think a lot of people choose option one simply because it seems so preposterous that they think, oh, well, that must be the right answer. Well, someone actually conducted this experiment. They tried every possible scenario, a lot of math, and I want to share the results with you from this experiment. So here they are, and I'll tell you how to read this. When this blue line goes above the horizontal dotted line, what that means is that that was a period of time when you should have chose option two, buy the dips. So you can see in the 1920s, buy the dips was the better choice, option two. Late 30s, early 40s, once again. When the blue line goes below the dotted line, that means option one, investing $100 a month was the better option. And you can see visually what the odds-on favorite would be. It's actually this monthly investment program. 70% of the time, that was the better choice to make. Pretty interesting, 70%. Now, keep in mind, I granted an enormous advantage to option two. And what was it? Perfect knowledge of the future, which of course none of us have. None of us saw the market shock that coronavirus brought to us. And so in practice, when we try to do this, buying the dip strategy, it's very difficult and we can get it wrong. And if we get it wrong by even just 2 months, if we make that assumption, which I think is reasonable, and then you recrunch the numbers on the problem, then monthly investment outperforms 97% of the time, virtually the entire time. Now, what is this magic? How can this be? Well, it's not magic. It's called dollar cost averaging, and it's very simple. It is the practice of investing a fixed amount of money at regular intervals over time. So perfect example is our $100 a month. Now the dollar amount can vary and the frequency can vary. It's the principle here of fixed amount of money, regular intervals over time. I'm going to show you on a chart why it works, but here's the verbal explanation. When we do this, we will naturally be buying more shares of any investment at lower prices, which is great. That's what we're trying to do. And we will naturally be buying less shares of any investment at higher prices, which is great. It's what we're trying to do. Let me show it to you. So let's look at a real decade here. This is the period of the 2000s, a brutal decade. You can see there were two very painful market crashes, 1 and 2. The second one was the great financial crisis. After the decade, the market was actually down 24%. This is why they call it the lost decade in investing. Many people say the hardest decade to invest in history. Well, how did dollar cost averaging do? Well, on the top, that's just the market performance, which I just showed you. That's the blue line. Down here in the green, what we're looking at is how many shares you're able to buy using a dollar cost averaging technique. Okay, so let me walk you through this. At the beginning of the decade, what do we see? The market is at a peak, which means prices are high. Therefore, when you make a fixed monthly investment, your money doesn't go very far, right? Because prices are high. So in this example, you're picking up only 3.5 shares. The market then begins to sell off. So as that fixed amount of money is being invested each month, that same amount of dollars is going further, right? Because prices are getting cheaper. So you're able to buy more and more shares the more the market sells off. Then the market recovers, your money starts to not go as far, the market crashes, you buy more shares, so on and so forth. Hopefully you can see the way this is working. Now, I wonder if you notice something about this chart. If you compare the shape of the blue line against the green, do you see anything interesting? Do you notice that this dollar cost averaging technique is in fact a buy the dips strategy in disguise? Do you see it? Do you see how the green line peaks right when the market troughs? Look at the second one. Could not be any more clear here. You talk about perfect timing, right? I can tell you that no one was thinking that this was the market bottom in March 2009. Everyone thought it was a fake rally. Well, you timed it perfectly. Now, of course, you weren't trying to time it. In fact, you probably weren't even thinking about it. You had a dollar cost averaging, set it and forget it program. It's built into the mechanism. Dollar cost averaging purchases nearly twice as many shares at low prices than at high prices. And just through this smart buying technique, you would not have been down 24%. You would have been positive 5.9% over this exact same decade. Pretty cool. Here's an unlikely quote for an investing presentation. This comes from Napoleon Bonaparte. And this was his definition for military genius. I like it for investing genius as well. He says this: the man who can do the average thing when all those around him are going crazy. I will admit that dollar cost averaging is very boring. You're not going to make for interesting dinner conversation when the topic turns to investing. No one is going to be impressed with your savvy strategy, but 97% of the time, you will be the wise person at the table. All right, number 4, remember the most powerful force in the universe. Believe it or not, the genius Albert Einstein once said this: the most powerful force in the universe is compound interest. Isn't that interesting? Compound interest is an investing force. So think about all the forces of nature that this man studied and codified into rules and equations. The most impressive thing that he discovered in the universe, the natural universe, is compound interest. Well, what is compound interest, and why would a person like Einstein be so impressed by it? Well, for this, I want to share with you a classic investing example called a very expensive cup of coffee. If you like to go buy coffee at your favorite coffee shop, Starbucks or wherever you like to go, chances are you're paying $3 for that cup of coffee. That is the national average. What if instead of buying $3 in coffee a day, you invested that amount? How much would you have after 40 years? Well, if we assume the historical growth rate of 6.7% that I shared at the beginning, it grows to more than 215,000. Not enough to retire on, but this is actually an incredible amount of growth, given that all you're doing is investing $3 a day. Now, why does it grow like this? Compound interest. So what is it? If you look up compound interest online, you might be confused. And it takes a minute to get your mind around this idea, but I'm going to try to break it down to you as simple as I can. And so what I'm going to do is I'm going to share with you a layman's definition. This one happens to come from Benjamin Franklin. Yes, that Benjamin Franklin. He was a huge fan of compound interest, just like Einstein. And he defines compound interest this way: money makes money, and money that makes money makes money. Which I realize I've helped you not at all, but you'll get it here in a minute. I'm going to show you a little bit of the math on this problem, and you'll see where he gets this brilliant definition. So what we're doing is investing $3 a day. $3 a day times 365 days in a year is $1,095. That's what goes into the investment account each year. So you invest $1,095 in the first year, and then what happens? It grows by the growth rate. So that at the end of year 1, you have this dollar amount. In year 2, compound interest kicks in. So first, you invest another $1,095. That's just what you're committed to doing instead of buying that coffee. It gets added to what was already in the account from the prior year. And then the whole thing grows again by 6.7%. So at the end of year 2, you have this amount. All the following years look the same. Now let's think about Benjamin Franklin here for just a moment. He says, money makes money. What he's saying is, hey, you got some money in your pocket and it makes money. How did that happen? You invested it and it grew by the growth rate. So that's the first part. And then he says, and that money that makes money starts to make money. What he means is you're not taking anything out of the account. You're reinvesting it, including the interest that you made the prior year. So all that money and the money that got some interest gets reinvested, and then it starts growing again. And this interest starts to make interest. Do you see that? This is called compound interest because the interest compounds. This is what it looks like if you graph it. So the yellow line shows you what $3 a day looks like. Because of investing in compound interest, you can see it grows to more than 215,000. What I want you to notice is the upward sloping line. What looks very humble in the early days looks very impressive in the later years. And this is what impressed Einstein, is this upward sloping function. The longer you let it go, the more powerful it is, which is why Andy and others at Hummel are always encouraging you to get started as soon as you can, because time is so powerful. Now, many of us are trying to invest more than $3 a day, so I just changed the numbers. I said, okay, what if you max out your IRA, $6,000 a year? It grows to more than 1.1 million. This is the everyday millionaire. I am certain that everyone who signed on to this call could find a way to do this with some careful life planning. It is not difficult to do this. Now, I told you that Ben Franklin was a big fan of compound interest, and he actually demonstrated this with his life. At the end of his life, he gave $5,000 to the city of Boston and $5,000 to the city of Philadelphia as gifts. He put it into an investment account, and he told the cities, you can't touch it for 200 years. He was a brilliant man. Well, if you look at the slope of this line at 40 years, you can imagine what it looks like at 200 when compound interest was just ripping. Do you know that $5,000 has turned into tens of millions of dollars? And that as much as governments like to spend money, Boston and Philadelphia have still not spent all that money to this day. Isn't that cool? Very powerful. And the reason it works is that time is on my side. Yes, it is. Very famous investors here, the Rolling Stones. And then here's a quote from Buffett. The stock market should be thought about as a machine that transfers money from the impatient to the patient. If you can be patient, man, it's very powerful. Time is a great friend because of the power of compound interest. All right, last point here, and then we'll conclude. Invest in businesses, not markets. I have this conviction that many of us have really lost sight of what investing is all about and the true purpose of investing. What do I mean here? Well, I think investing has really become divorced from its original and most basic idea, which is about supplying capital to support businesses. What is investing like today? Well, today, many people picture it as trying to profit from the market as this kind of abstract financial thing where you put your money in to the market and then ride this wave and hope it spits out a greater result in the future. And we sometimes forget that there are businesses behind the scenes. In fact, I'll speak to people and they often will have a difficult time even conceptualizing the market as just businesses. But this is what it is. Now, what happens when we adopt the market view instead of thinking about the businesses we're investing in? Well, our relationship becomes one of performance to the market. So when the market is up, we're going to feel great. And when the market is down, we'll start to worry. We'll ebb and flow with the market performance. I want to share with you a quote from a person at DePaul University who I've gotten to know. This is William Kavanaugh. He says, retirement accounts tend to just go into mutual funds, whereas an investor, not only do I not have any idea how the companies that I have stock in are being operated, I don't even know what companies I have stock in. And these investments tend to be run by an elite of managers whose one preoccupation is with increasing the bottom line. You ever thought about investing and just wondered, man, where's my money going? Where are the returns coming from? What are the companies that I'm owning here? What are the products and services and business practices that are funding my future? And how do I feel about all this? A lot of us never really give this much thought. Let me give you a quote from actually a very famous portfolio manager, Cliff Asness. I was listening to him speak at an investing conference a few years back. He was speaking about his investment approach. And he said this, I'll never forget it. He said, I pride myself on not knowing what's in our portfolios. So not only do we often not know what we're investing in, but even the people that are choosing the companies are often ignorant to this as well. It's kind of odd, right? Because this guy, his job is to choose the companies for the portfolio that his clients will own. And he's saying he considers it a point of pride to not even know what's in his portfolio. Why is that? He's a numbers guy. So if he's looking at a stock, if it's got the right combination of metrics and numbers, hey, it's good. It makes it into the portfolio. And he's so disciplined about this that he actually removes the names of the companies from his view so that he's not biased in any way and can just focus on the numbers. I think it's admirable, that level of discipline that he's brought to his process. But I think this signals just a disappointing direction in the field of investing, where investing just becomes about getting a profit result without much consideration about how that was earned. And I'd like here at the end to just try to recover a vision for investing. What I want you to remember is that investing is company ownership. At its most basic level, what's happening behind the scenes is a supply of capital to support business in exchange for ownership, which gives us the rights to receive any of the profits and growth. All of the profits and growth come from the activities of business, which is why investing always entails ethical decisions and values decisions. So what I'd like to suggest is that in addition to the financial questions, we ask some ownership questions. To get you thinking about this, we could have questions about, let's say, how the management teams of these businesses are running the companies. And through the management teams, how those companies are serving customers, employees, suppliers, communities, the environment, broader society. Here are some questions that I like to ask. This is what we ask ourselves here at my company. We ask, hey, would we want to work under this leadership team? How likely would we be to recommend their product or service to a friend or colleague? Would we want our son or daughter to work at this company? It's a nice litmus test. On a scale of 1 to 10, 1's a new flavor of gum, 10's a cure for cancer, how much value does the company's products and services bring to humankind? If we walked into a supply center, would we be proud of the quality and working conditions that we observed? What would our reaction be if this company opened an office in our neighborhood? And does this company's environmental policy and actions leave a better planet for our grandchildren? These are company ownership questions. And if we see investing as just the market, they never come to mind. But if we remember that investing is company ownership, I think questions like these make all the sense in the world. Let me leave you with this. This is a quote from one of my colleagues. I like the way that he's captured the idea here. He says, many people have had the experience of purchasing a stock, becoming nervous as it declined, and then selling out at a loss, perhaps only to see it go right back up again. On the other hand, if a person knows the business the stock represents, trusts management, and so comes to believe in the company, these declines are not so troubling. That person is a confident investor because history has shown that great businesses not only endure downturns, but emerge even stronger, making these declines attractive points to invest further. When you understand the merits of the companies in which you invest and better appreciate what you own, you can transcend a mere chart-based financial relationship in investing. You can have greater confidence and less stress because you're not buying mere paper or a derivative, but a portfolio of quality businesses you know and trust. After all, life should not be spent staring at computer screens, watching ticker gyrations, but instead free from needless stress. All right, one last time, the timeless truths for investing. Keep your eye on the owner, not the dog. Restrain yourself. Employ a system that forces you to buy low. Remember the most powerful force in the universe, and invest in businesses, not markets. With that, I'm going to welcome Andy back on and to guide us through the end here.
Jason, thanks so much for your presentation. Those fundamental bullet points of investing are very powerful. And at the end there, kind of tying the investment conversation into a bigger picture values conversation has been very powerful for our clients as well. So we're going to transition into a Q&A here in a minute. So you've got a couple seconds left. If you have a question and would still like to submit that, please do so. I just wanted to expand what I mentioned there a second ago. We've really here at Hummel enjoyed working with Eventide over the last couple years, and it's really been about helping our clients who have values-based convictions align their portfolio choices with those convictions. So that is not an impossibility. That is something that you can achieve within your portfolios. You see our advisor team here on the screen. Any one of our team is happy to have that conversation with you. So feel free to reach out and initiate that. Just to let you know, to continue this conversation, so we're going to dig a little deeper into the values-based investing world and Eventide's approach as we move through this. We're going to have 2 more webinars over the remainder of the summer and into the fall here. So if you want to jot this down, there will also be invites forthcoming via email and social media, of course. But Wednesday, the 18th of August will be our next meeting together. That topic will be the power of investing to change the world. So does investing with a values-based approach actually do any good? And that's a very interesting topic. And then finally, we'll meet on September 29th, also Wednesday. These are both at noon, same lunch hour setup. That one will be focusing on it's called the 3 dimensions of values-based investing. So that'll really kind of dig into what that really means. And yeah, let me check to see if there are any questions. There are not. So I guess we're off the hook, Jason. No tough ones today.
Great.
So thanks again for joining us today, everybody. Hope you have a great afternoon and a great finish to your week here. Take care.
Excellent. Thanks so much.